Hey everybody, Abdullah Shamari here. We're going to continue our series on how to read financial statements. We'll be going through the income statement today. Let's do it. Make sure to subscribe to my page, crush the like button for the YouTube algorithm, and check out my Patreon link below. You'll get insights into my watch list, my portfolio, my daily readings, as well as instant posts as I'm buying and selling each and every day. Today we'll be continuing our series on reading financial statements, and we'll be specifically focusing on the income statement, how to read it, what's on the line items, what could be the various different information that companies could share on the income statement, and to be able to give some background on the individual line items so that you're a little bit more well informed on what you're reading when you're looking through the 10K. We're back here on the SEC website going through the income statement. If you're looking into how to be able to get to the SEC website or how to get to the 10K for a specific company, check out one of my other videos on the balance sheet as well as the statement of cash flows in order to be able to understand how to navigate here, and then also get more information on the two other statements that are presented as part of the 10K. So here we'll be navigating to the consolidated statements of income. So this is the statement of income, or as many people call it, the P&L for Illumina Inc. First and foremost, as we all know, top line, we see revenue. Here, the company divides revenue into product revenue and then also service revenue. So they sell products, they sell various lab equipment or testing equipment for universities as well as various enterprise customers to use. And then in addition, they probably provide some kind of service related to that, whether it's warranty or maintenance services for the equipment in order to be able to keep it up to date, etc. So then we have total revenue, which here is 3.2 billion. And then right under it, it's usually, if the company is a revenue generating company, it'll have costs of revenue, and then it'll be split into the same categories as the revenue above. And then any costs outside of that, depending on how much they are, they could be listed as line items on its own. So in this case, amortization of acquired intangible assets, it's significant enough at $28 million that the company's listed it out separately. And before, it used to be even more significant. So it used to be 35 and 34 in previous years. So they have separated it out as part of their listing of their costs. Next, we go into operating expenses. Generally, it's split into research and development and then SG&A, selling, general, administrative. Some companies will also have marketing depending on how the company structure is and how significant their marketing expenses are. So in this case, it's just the two categories. So then it comes to our total operating expenses. And then we have income from operations. So this is telling us how much money the company made specifically from their operations, their day-to-day operations, outside of any interest, taxes, etc., or other income they might have gotten during the period. Below that, we'll have interest income, interest expense. We'll have other income that the company got related to various other factors, such as like income that they've gotten from their investments. So it'll be listed here. And then that'll total to total other income. And then we have income before income taxes. Many profitable companies will have significant tax liabilities. So as a result, they'll incur significant tax expenses. So they usually separate it out on the income statement here. We can see provision for income taxes, $200 million. These are expenses that the company owes for various taxes. And then we finally get to consolidated net income, which is $656 million. Then the company will usually list out their basic and their diluted EPS, or earnings per share. So the difference between the basic and diluted is just a difference of how many shares the company currently has outstanding that might not necessarily be reflected in their basic earnings per share calculation. So it could be they have warrants out there that people could potentially exercise, and that will bring their net loss down. So they'll list out their diluted net loss as well, or net income, depending on where the company is. In this case, we're in a net income position. So it'll show their net income as lower based off of the additional shares, or it could be less shares compared to what the basic is, depending on the different calculations. There's very specific accounting rules when it comes to this. It can get very complicated, and as a result, it's important for companies to list both their basic and diluted and following through through all the criteria required there. We also show here the basic shares and the diluted number of shares that they have. So 147 million versus 148 million for diluted. So we can see here that basic had less shares, which is why the earnings per share was higher. So that was an overview of the income statement. Pretty basic when you compare it to what we had gone over from a balance sheet perspective as well as a cash flow statement perspective, but very important because it tells us what the company is doing from an operations perspective and how much profit they're generating from their day-to-day business. So it's always important to look at the income statement, balance sheet, and cash flow statement. In future videos, we'll be going through the footnotes of the financials as well as some other additional statements that the company might have, like the statement of equity, like the comprehensive statement of income, where it might include the company's various FX changes that it has if it has international operations. So be on the lookout for those videos. As always, make money, enjoy life. Peace.